This is the value of my stocks and shares ISA investments right now, about £93,000. My goal is to grow it to £1 million over the next few decades. And today I'm breaking down exactly how I plan to do it, with real numbers, real mistakes, and real lessons that I've learned along the way. So let's start with where I am right now. My stocks and shares ISA is currently worth £93,000. I also have a SIP, aka a self-invested personal pension in addition to this, but we'll focus on the ISA in this video for simplicity. But what exactly is a stocks and shares ISA? If you're in the UK and you're serious about investing, this is one of the best tools available. A stocks and shares ISA is an investment account that lets you invest in the stock market without paying tax on your gains or dividends. The UK government lets you invest up to £20,000 per year into an ISA, and anything inside that account grows without you having to worry about tax. That is why I use an ISA. Over 20 or 30 years, these tax savings can compound into thousands or even tens of thousands of pounds. But while having a tax-free account is great, the real power comes from what you invest in. And that brings me on to my next point. Now, let me just say this. I didn't start with £90,000. And I feel like this is something a lot of people don't realize about investing. You don't need to start with a lot of money. In fact, when I made my first investment back in 2020, I started with just £50 on Trading 212. And I remember thinking, what's the point? £50 is nothing. Because when you invest £50 and the market goes up 5%, you've made £2.50. That's not exactly life-changing, is it? But what I didn't understand at the time was the power of consistency. I didn't need to start with thousands. I just needed to start. Then, as I earned more money and got more confident, I increased my contributions. In fact, during lockdowns, my expenses fell sharply, and I had a lot more money to invest and a lot more time on my hands as well, which actually wasn't great for my portfolio. I panic sold investments, I bought into random stocks that I didn't understand, and unsurprisingly, I lost money because of it. At one point in 2022, in fact, my portfolio almost got cut in half. But I kept going. I kept learning, I kept investing, and in 2024, I started making a profit again. And if there's one thing that I want you to take away from this video, is that you don't have to be perfect to start investing. You just have to start. My total profit so far is about £21,000, and my money-weighted rate of return is around 70%. This return accounts for the fact that I added money over time rather than invested it all at once. Now, let's talk about why consistency matters and how it turns small investments into big money over time. Over time, I've varied how much I contribute to my stocks and shares ISA. At the minute, I add £750 every month when I get paid. If I continue investing £750 per month, and the market delivers an average return of 6.5% per year, my ISA could grow to £1 million by the time I turn 55. I'm now 29, by the way. But here's the crazy part. Over that time, I will have only contributed £234,000 myself. The remaining £744,000 comes from the investment growth alone. And this is the power of compounding. At first, you do most of the heavy lifting because your contributions make up most of your portfolio. But over time, your money starts making money for you. This is why investing early matters, because the longer you give your money to grow, the more compounding works in your favor. And this is also the key difference between saving and investing. If I had just saved this money in a bank account, not only would I probably get a lower return over the long run, but my money would probably fall in value in real terms. That is, after taking inflation into account. To illustrate this, let's take a look at a little analysis done by Vanguard, one of the largest asset managers in the world. They looked at how £10,000 invested at the end of 1998 in cash and in shares would have performed by the end of 2024. They found that a £10,000 investment in cash at the end of 1998 would have grown to about £19,000 by the end of 2024. But after adjusting for inflation, so for the fact that the prices of goods and services goes up over time, its value would have more than halved from £10,000 to £4,900. In contrast, a £10,000 investment in the global stock market would have grown to about £78,000 or to £64,000 after adjusting for inflation. Not only is that almost 7 times your initial £10,000 investment after inflation, but it's about 13 times as much compared to the £10,000 held in cash. Past performance is not a guarantee of future results, and it is important to keep cash savings on hand for emergencies or unexpected events like a job loss. But beyond this, as Vanguard itself says in its article, Holding too much cash could mean missing out on achieving your financial goals, especially as the rates on cash savings are likely to fall further this year. This Vanguard article is also the reason why I chose an assumption of 6.5% annual return. The fact that a £10,000 investment grew to £64,000 after adjusting for inflation over the last 26 years gives a compound annual growth rate of about 7.4%. So after accounting for fees and everything, I thought 6.5% is a reasonable, if not slightly conservative assumption. But crucially, it is an assumption. Now, let's talk about my investing strategy. So I keep it quite simple. I started investing solely in individual stocks, but over time I've shifted more towards index funds, which are baskets of hundreds and sometimes even thousands of stocks meant to track the performance of the stock market. At the minute, I have about 60% of my stocks and shares ISA in index funds and the rest in individual stocks. But over time, I plan to increase my allocation to index funds even further. I personally use Trading 212 for my stocks and shares ISA because it has really low fees, which again means that I can keep more of my hard-earned money. You can use promo code SNSBonus to get free fractional shares up to £100 when you join Trading 212. This is an affiliate code, meaning that we get a small payment which helps support our free content. The cornerstone of my portfolio is a global index fund, which allows me to gain exposure to thousands of companies around the world in one simple investment. That global index fund is the Invesco FTSE All World ETF, ticker symbol FTWG, because it gives me instant diversification across the world. Now, I chose this ETF because it has relatively low fees at just 0.15% per year. And Invesco is a very reputable provider, but it is a fairly new ETF. It started trading on the market in June 2023, I believe. An equivalent ETF that has a longer track record but is a bit more expensive with an annual fee of 0.23% is the Vanguard FTSE All World ETF, ticker symbol VWRL. These are not recommendations, by the way, they're just some examples. Remember to always do your own research or consult a financial advisor if you're not sure. Before I wrap up, let's talk about the biggest mistakes I made when I started investing, so that you don't make them too. The first one is panic selling. At the start, when my portfolio dropped, I panicked and sold a lot of stocks at a loss, thinking I was protecting my money. But a lot of the time, if I had just held on, those investments would have recovered and then some. The lesson I learned from that is that the stock market moves in cycles. Drops are absolutely normal, particularly in the short term. And if you're investing for the long term, these short-term dips don't really matter. Here's how to avoid making the same mistake. First, when in doubt, zoom out. The market grows over decades, not days. If your goal is to invest for decades, then stay focused on that, not on short-term fluctuations. The second mistake was chasing hype and trends, basically buying stocks that I didn't understand. Sometimes I would see a stock trending on social media, and without thinking, I would buy in. Some went up, but most crashed. I had very little idea why I even owned them, to be honest. The lesson here is not to give in to FOMO. Most hot stocks don't last. If you want to avoid this, make sure you understand what you're buying. Also, stick to a long-term strategy rather than give in to hype. And finally, avoid get-rich-quick thinking. If it sounds too good to be true, it probably is. The last mistake is trying to time the market. At the start, I kept waiting for the right time to invest. When the market dropped, I waited for it to drop even more. And when it went up, I thought it was too late. The problem is that the market doesn't wait for you. While I was waiting for the perfect time, the market kept climbing. And the longer I hesitated, the more I missed out. So if I were to start again, I would start now, even if it's small. And instead of waiting for the perfect time, I would use dollar cost averaging or pound cost averaging since we're in the UK. This means investing a fixed amount regularly. For example, every time when you get paid. This in turn smooths out market ups and downs. Because remember, waiting to invest can be risky too, because as we've seen earlier, inflation erodes the value of cash. If there's one thing I want you to take away from this video is that you don't have to be an expert to start investing. I started with £50. The key is to start with what you have and stay consistent. If you found this video helpful, give it a thumbs up. And if you want to stay up to date with our investments and our journeys, hit that subscribe button. Until next time, bye!